warm welcome, please, to Dr. Gary Dayton.
Thank you. Actually, my name is Rollo Tape. Let's see if I can put this stuff on. So I've got to hold this and do this. Hi, everybody. My name is Gary Dayton, and I'm really tickled pink to be here today. Two folks sitting over here, for better or for worse, are really responsible for my ability in reading the charts and trading the markets from a Wyckoff perspective. Linda Ratschke one time told me that if you really want to understand the technical side of trading, you got to study Wyckoff. She said, you understand Wyckoff and you'll understand 90% of technical analysis. And actually, I think she underestimated by saying 90%. So that was quite a while ago, and I said, who's this Wyckoff guy anyway? Who is he and what's he all about? So I Googled, and what I came up with was Gary Follett's website. And Gary offered, and I think still continues to offer, a free training program in Wyckoff every Monday, Tuesday, and Wednesday nights, which is just outstanding. I mean, it took me a while to figure out what he was talking about, up thrusts and springs and breaking through the ice and so on and so forth. But that was really a very valuable education. And then I was introduced through Gary to David Weiss. I spent quite a bit of time with David just going through bar by bar charts and just really learning this stuff really, really well. And, you know, the scales fall off the eyes and the eyes open up and you begin to see a new, you know, the veil parts from the nature of the markets, and she shows us what's behind those veils. And so I owe a lot to these guys. I stand on their shoulders, and of course they stand on Wyckoff's shoulders. And it's as I say, I'm tickled to be here just to see these guys again. So Wyckoff wrote his Richard D. Wyckoff Method of Trading and Investing in Stocks, a course of instruction in stock market science and technique. He was a fairly long-winded guy. He wrote this in the very early 1930s, 1930 and 1931, and it was published for the first time in 31 and 32. And then we were just talking about this earlier. He died shortly after that. But the course lives on, and you can still get a copy of it from the Stock Market Institute, which is now based in Phoenix, Arizona. Everybody familiar with the course, by the way? Everybody have it and read it?
Who's not familiar with it?
Who's not familiar with it? Ah, okay. So few folks are not. It was first written by Wyckoff in as I say, 1930-31, and published as a course of instruction. And it would be sent out in installments to folks. And then over the years, it was rewritten partially and expanded, mainly by Bob Evans, who created sort of what they call the New Testament of the Wyckoff method. But the original course is still available from, as I say, Wyckoff Stock Market Institute. If you Google that, you'll find it. I think it's about $1,000 these days, $800 to $1,000, well worth it. Pardon me? Okay, yeah. So it might even be a little bit cheaper than that. But you need to look at that, and you'll find it on the web. And now SMI for the first time has also got a website too, and Craig Schroeder and Gary Schuber and the fellows that are there do a pretty good job of keeping the Wyckoff method going. Now, one of the things that David actually talked to me about or taught me about was this section of the Wyckoff course called Section 7M, which was Wyckoff's case study of the 1930-1931 stock market as it was then represented by the New York Times average of 50 stocks. I don't know what stocks were in there, in that average, but it was essentially equivalent to the Dow or to the S&P 500 today. It was an index. And he used that to evaluate the trend of the market. And David and I spent quite a bit of time on that. And David had said to me at one point, I pick up on things. When people say this is important, I kind of listen and then go and do my own study of it. And he said that it profoundly influenced his trading, if I remember your words correctly. And I think as we go through it today, because I'm going to do a lot of sections of that case study that Wyckoff did, and try to show you how it's applied in the current markets as well. But it really is a profound writing of how to read the market by its own actions. And Wyckoff started off and said that he began section 7M with this statement. He said, the most important thing to know about the market is the trend. Since we aim generally to operate in harmony with this trend, a study of our daily trend chart, daily vertical chart of a composite stock average, in other words, just a bar and volume chart, should be the starting point of all of our deductions. And that's what he focused on, was this average of 50 stocks, in the 1930 and 31 market. And in my opinion, and I think as Gary and David will tell you and show you, this stuff is as alive today as it was 75, 80 years ago. So with that, we'll start off. And here's how Wyckoff represented it originally in the original course. It was all hand-drawn. There were no computers, of course, at the time, and everything was done by hand, which, in fact, David will say that he used to draw charts and still does draw charts by hand. Tom Williams did that as well as a chartist for a hedge fund or a syndicate. And this is what they used. Now, in this chart, you'll see, can everybody see this okay?
Yeah.
Okay. You'll see that, it's immediately going to do that to me, isn't it? You'll see at the bottom here, there are these little S's. Those stand for Saturdays. The market at the time was open for a half a day or for a couple of hours on Saturdays. It says the battery here is running out of juice. So,
Shouldn't be.
okay. So what Wyckoff did was he took those days and he doubled the volume. Okay. And when you just look at this chart as it stands, it's not that easy to read, is it? I mean, it's just a bunch of lines on a chart paper with some horizontal volume bars, but they really do tell a story. So we'll take a look at that. Fortunately, a person took the SMI charts, which are, if anybody knows the course, they're really hard to read. I wound up buying an 8.5 by 11 magnifying glass to look over to be able to study them. But somebody took this 1930-31 market, which actually was a bear market rally in the declining Great Depression market. And this market went down quite a bit further than this afterwards. But he took and just with a magnifying glass, painstakingly figured out where the high, low, and close and the volume figures were for each day from December of 1930 to November of 1931 and put them into a Excel file, which we then converted over to the Metastock trading software. So we don't have to rely on the hand charts themselves. We can look at this. We can look at this from a computer-generated, and we'll do that section by section. The interesting thing, when I look at this chart, what strikes me is that even though this was a heck of a bear market, I guess the worst one that we've ever had, or it has to be up there in the top, of the worst ones that we ever had. There were still nice bull market rallies in this, or bear market rallies in this overall bear market. So we'll start with one of the main principles, just as Wyckoff started, with the selling climax, followed by a secondary test. What do we know? What do you all know about a selling climax? What is it supposed to represent? What happens in a selling climax? Panic, right? Okay, what else happens? High volume. Is it all buying or all selling, or both sellers and buyers, right? So we're seeing high volume and lots of activity, panicky selling going on, so lots of supply coming into the market. Selling equals supply. But also, we're seeing buying coming into the market as well. Okay, so there's an expansion of both supply and demand. And Wyckoff talked about this as supply of a poor quality being the panicky dumping of stocks. Some people will say puking them out, throwing them over. Because, yeah, they're liquidating long positions. That's right. They can't stand the losses any longer. And from a mass psychology kind of perspective, and the market is kind of a big, large group, and groups tend to act in unison. Not everybody in lockstep, per se, but in general, on average, people will act all around the same time. And that's what we see here. We see capitulation at the same time. And if it's at a point where it's attractive to larger interests, you'll see those larger interests come in and buy. But how do we know that it's a climax and not something different? What are some of the characteristics of a selling climax?
Ultra-high volume.
Ultra-high volume, right? Pardon me? Wide range or widespread. Everybody understand what the range or the spread is? The range or the spread, they're synonymous terms. The difference between the high and the low of the bar. Okay? So wide spreads or wide ranges, high volume. What else is occurring?
Usually occurs at the end of a decline.
Yeah, typically it'll come in at the end of the decline, and it marks the end of the decline, in fact. We also tend to see an acceleration of the downtrend. It's not real clear. This is, by the way, the December 1930 selling climax. We see an acceleration in the stride or the angle of descent in the trend itself. Okay, I've got some modern day charts that we'll see where you can see that as well. So keep that in mind. But we need to also see one other component here, and that is that buying is coming in. It must be evident. Can everybody see this bar here, this widespread bar right here that I'm highlighting with this arrow? It looks like I'm a kid doing this, right, from first grade. Everybody see that bar? What do you notice about that bar? What's notable about that? Closes on the high, right? In comparison to every other bar in that downtrend, what are we seeing? We're seeing just the opposite occurring. And it's not only just closing on its high relative to the bar itself, that bar that it's painting, but it's also closing above the closes of the previous three bars, wiping out all the selling that was going on there. And it's closing up above the high of the previous two bars. So real strong evidence of demand or buying coming in on very high volume as we're coming down precipitously, or however you say that, and everybody else is throwing out their stock, right? Right? Everybody see that? And then the market rallies, and we get a little bit of a technical bump up in the market. As it comes back down, what do we notice here? Whoops. Lower volume, right? Yeah. What else are we noticing? Support. How are we seeing support? What do you mean support? How do you see that? The lows are refusing to go down below a certain level. Yeah, exactly. Good observation. You can see all those lows are right at the same level, right? The volume, compared to the volume on the down move here, the volume on this down move. And we're going to talk a lot about that a little bit later on and also tomorrow. Comparing, Wyckoff used to think in terms of waves more than he did in terms of bars. He talked about both, but he was also very, very cognizant of how the market moved in waves. And he would look at the volume on one wave, a down wave, and then he'd look at the volume on the next down wave after an interceding rally, and he would compare the two, okay? And he would see, as we see here, the volume is lighter than it was on the larger down wave that was coming in. So that indicated that selling is drying up, right? We also notice that the spreads are more narrow. There's less, spread is equivalent to activity, as is volume, right? So there's less activity going on there than there was on the previous downturn, or downswing, I should say. And also he noticed one thing here, that on the last few bars, the last 3 bars, I kind of wiped it out here, but what do you notice about the closes? They're all clustering right in the same area. Some of you guys have been working with me. You know this, right? Yeah. So it's what Wyckoff called clustering of closes. They're all closing at the same area, meaning that after 3 or 4 days here of activity, there's no further movement to the downside. David calls this no further follow-through, right? It's just refusing to go down any lower. So that's a climax. Yeah, go ahead.
Question, mostly for David, because he's got an association
Sure.
with Elliott wave.
Uh-huh.
Would you consider this like like wave 1 start of
Gary, you need to repeat the question.
Question is to David, actually, about this chart and with reference to Elliott wave. Would you consider this to be the first of a 5-wave impulse on an Elliott wave basis?
You need to repeat what he says.
It would just be the beginning of some kind of a pattern. It might be wave A or it might be wave 1. We don't know. Without having an understanding of the bigger picture. But it would be fair to call it wave 1 and be wave 2, yes.
Okay. And
Do you want to repeat that for the audience?
yeah, and David says it would be fair to call it wave 1, but you'd have to be taking into account the background and the structure of the market, because it could just be an A wave and a reaction too.
And question for Paul, this is where you start thinking about going forward, right?
In all honesty, I'd need more context.
Assuming that it's what we think it is.
So once you see major pivots like that, depending on whether you take out prior lows, then I'd be looking to draw medium range. Not a lot of context there.
Gary, could you just repeat that for the audience?
I'm sorry, I didn't.
Yeah, no, just because you got the question was. Sorry, can you repeat the question?
The question is, this is where we think about.
Oh, the pitchforks, yeah. A question came in from the audience. Is this, to Paul, is this where you would begin to use your analysis with pitchforks and such? And Paul said he'd begin to think about it, but he would still need more context, not too dissimilar from what David was saying. So in a climax, what we need to see is the climax followed by a test. Okay, without a test, we're not sure whether the climax is going to hold or not. But Wyckoff considered this as the end of the downtrend once it's successfully tested. Let's take a look at a couple of climaxes and secondary tests that have occurred recently. Here is a weekly chart of the SPY where we get some climactic action. See the acceleration in this move down here, where the stride or the angle accelerates. And then we get some clear buying coming in. It gets tested, still fairly heavy volume, right? And still some pretty good move down where volume is still increasing. It rallies up and then it gets tested again. And this, I think, was the 203 market, if I'm not mistaken, on a weekly basis, and then it rallies up from there. Here's one on a 5-minute S&P chart. Here I drew in the angle of descent. You can see that we're coming down, and we get a little steeper, we get even steeper still, and then it plummets. Right? Volume expands. We're seeing the largest volume on the chart. Right? We get a rally up, we come back down, and we see a test. And the test generally is on lighter volume. And the way to see that the test is is successful as we would expect to see some movement to the upside, right? Some acceleration coming up, which we see here. Any questions on this? Everybody snoozing after lunch?
Yeah. That looks like the oil chart, that I showed earlier.
Oh yeah, they begin to look very similar from one to the other. Here is a daily chart, IMW. This is, I forget exactly when this was, but we have, and sometimes it's not real easy to tell whether this is a climax here or maybe it's just preliminary support. Wyckoff never really talked about preliminary support. I think that was from Evans and that group, right? But Evans noticed that often we'll see some climactic kind of action occur, market rebound, and we might go lower, and the real climax then comes in. We have that technical rally, then testing occurs, and we get that last point of support. And that's kind of what we're seeing here, the testing coming in at C here. Question I'm often asked, and even sometimes for myself, it's always not easy to figure out. But we have something called stopping volume, which is just as it sounds, where the market might be coming down and volume comes in and stops the market from going any further, causing it to rally, though it then will come back down again and go a little bit lower. How do we tell the difference between stopping volume and climactic action, where we really will get a good rally after that? What do you think? And this is a chart that tries to help show that. What do you think are some of the differences here? Pardon me? Smaller spread, yeah, on A and B, right, which is more stopping volume, right? What else? That angle of descent, right? Look at it plummet here. And here, you could almost say that this might be kind of climactic, and it is to some degree, but volume is really expanding on the down wave, and then on the up wave, it's not coming in. But it doesn't also get tested very well, does it? Either of these stopping volume indications. But here at D, the climactic action that we see at C, which is also has more clear evidence of buying. Does everybody see that at C, where we drop down and then rally up well into the bar before it? That has to be buying that's coming in. It can't be anything different. If it was still selling on all that volume, we would go lower and lower and lower, right? Does that make sense to people? Okay. We don't really see that on A and B. Certainly buying came in at both of those points because it had to stop it, but it wasn't really climactic. And we never get the testing that occurs here on D. Is this helpful? Is this okay? Okay. And here's not last Thursday, but the week ago Thursday, but just on a 5-minute chart. I don't know if that certainly it was climactic here. You can see the buying coming in pretty clearly. But on the higher time frames, the jury is still out. Here's the market. This is the ETF for the Dow market, the diamonds. And here we are at the bottom of the 2008-2009 bear market. And this is March right here of 2009. To me, at least, potentially climactic here, looks climactic to me, but the testing really doesn't hold, and we drop down, and I wouldn't say that this was, I don't know, a valid test, really. It looks like it's, I guess what the SMI folks would call a number one spring. It just keeps on going down. It just keeps on oozing lower and lower. But the market did turn up from here. How would we know that the market might be turning up from here? How would we begin to think about that if no real clear climax has occurred? Because we don't always get a climax. Lower volume is one. Yep. What else? Are we seeing the acceleration of the downtrend over here like we saw over here? No, right? Everybody see that? That this area here has not only got lower volume, but the spreads and the angle of descent, the stride, is not as severe as it was over here. Still, though, that, it still makes it hard for us to say, okay, well, we can think that maybe the market will turn here. Possibly, but it's still kind of hard, at least in the way I would approach it. Wyckoff, Wyckoff in his course also talked about looking at, he used individual stocks. He would say, look at comparative strength and comparative weakness. He would not only just use the sort of deductive method that we were just looking at, but also an inductive method. In other words, looking at the individual components and building a case rather than looking at the general and building a case for individual stocks. So here, for example, I've got the diamonds in orange up above, and in brown, I've got the Qs, the NASDAQ ETF. And notice, we make lows at A in both markets. What do you see at B? What's happening here between the two markets? So, pardon me? I didn't hear that. It peaked, okay. On the rally, does B on the rally to B in the Qs, does it look stronger than the diamonds? It does, right? It's showing some relative strength. On the diamonds, we barely get up above the last swing high. We don't even get up above the last swing high. But on the Qs, not only do we get up above the last swing high, but we come up and top at the prior high. Okay, everybody see that? So from right at that point, we can begin to say, gee, there's some strength in the market that's not evident in the overall composite, but there is in a portion of this market. What about at C? What's happening here at C? What do you see here? A higher low is being put in, right? Whereas the Dow, as represented by the diamonds, is coming down and going underneath its low of the fall here, November of 2009. On the Qs, it's holding a higher low, okay? So that's indicating some relative strength has come into the market. That's maybe masked by the overall market. Now you can look at this in terms of, as Wyckoff did, in terms of individual stocks as well. Here's Goldman Sachs on the bottom here in black, and SPY, the ETF for the S&P 500, in blue on top. Wyckoff looked at leader stocks. He constructed his own day trading type of composite index from a half a dozen leading stocks of the day. Now, maybe Goldman Sachs isn't quite the leader that it was back a year or so ago because of the fraud allegations on the what was it that the SEC had charged them with. But you can see here, just like in the Qs, Goldman Sachs made a higher high, relative high, compared to the overall index, and made a higher low at B. Okay? And you can have a group of individual stocks that you consider to be leading stocks, and track those against the overall market. One thing you can do is just look at the IBD 100. Those are sort of rocket type stocks, right? They will move to the upside whenever, because they're really highly refined in terms of earnings and growth and all of that sort of stuff. So when they start, you can track that against the overall market, and it's not a bad one to do. The other good one is there's a bunch, but another one, it would be the value line T100, the timeliest 100 timeliest stocks. Pick out either individual stocks from that group or the IBD 100, or track those indexes as we do here with the Qs. And you can also look at them in terms of groups or sectors. Wyckoff used to look at different groups of stocks. He would take, rails were big during his day, so he'd take 4 or 5 of the, like Reading Railroad and I don't know, whatever the railroad stocks were at that time. He'd combine those together into group indexes. We would call them sectors today, but it's the same thing. This is a weekly chart of the SPY on top. Then there's XLI, that's the industrial sector, the spider sector. XLK is technology, and then XLY is consumer discretionary. And there are 8 of them that are leading sectors in the XL spider category. So you can use those, and they're very helpful to track. And you can see here that the industrials were making lows at the same time that the overall market was making lows, but that the technology stocks and consumer discretionary were holding higher here. So giving us a clue that potentially we were seeing a market start to change. And it was coming in at a time, I remember talking to some folks down on Wall Street, and they were saying, boy, it really does feel like this is going to be another recession, another depression, if not a serious recession. And it usually comes in when the pessimism is the most high. Okay? So this is an example of how to use other information from the market when we don't quite have climactic action. Okay? Everybody understand that? Yeah, go ahead. Question.
If you were trading gold as a stock, you potentially could look at an index like the Dow as a proxy entry to potentially look for climatic sell on the Dow, knowing that Goldman has relative strength, and if you potentially had an entry on the Dow, you feel more comfortable using Goldman as your trading vehicle, knowing that it has relative strength.
Yep. Yeah, you could do that. You can also. Oh, yeah. Yeah, no.
The audience keeps saying to me, we can't hear the question.
Sorry, folks, in the audience there. Question was, if you have a climactic action on the composite index, like the SPY or the Dow, then if you're trading a vehicle like Goldman Sachs, make sure I get this question correct, and you see that it's holding a higher low, you have more confidence being able to go in on that. And that's absolutely right. That's absolutely right. In a case like this, you might want to wait for, both. Might want to wait for Goldman to make a higher high and then look for an entry somewhere in here. And I forget what the price was that Goldman went to. It was something like $170 or so.
Just say don't, Gary, that Tom picked that stock back in February. Do you remember?
Mm-hmm.
In the VSA Club, it was outperforming the sector. It had a massive markdown by, you want to make a note, it's April the 14th, 2009.
Mm-hmm.
Goldman Sachs, giant shakeout with strength in the background. You might want to point that out to the audience as well. And it was outperforming the sector, to answer your point. And the scanner that we use, it was top for about 6 months.
Right.
That and JPM.
Right. And Gavin just made the point that Tom Williams had identified Goldman as a holding stronger than the market and as a potential long-side trading vehicle as this massive shakeout in the fall of, as we were seeing really a waterfall cascading decline in stocks in the fall of 2009. And it was I remember him doing that, and it was a really nice call. But yeah, you can certainly do that. You can certainly use that. And it's a very helpful way to use stocks. As we open this, as Wyckoff opened his section 7M, the trend is the most important thing to know about the market. And you want to look at the overall index that you're following to understand what the trend is, and then select your stocks based on how that trend is unfolding on the overall index. And you want to try to find stocks, if we're in an uptrend, you want to try to find stocks that are comparatively stronger than the index. Very similar here to what we're talking about in terms of Goldman Sachs. We would look for buying as it's holding higher lows. And if we're in a downtrend, just the opposite. You want to see it be weaker. Okay? But here what I'm doing is using it in sort of the reverse side. You can go back and forth with this. I'm showing you how to look at this even when the climax might not be clear, to identify a potential change in trend in the market. So what happens now after we have climactic action to the downside, a testing of that? What's the next step? What do we want to see next in the market? We want to see a rally, right? So we want to see a rally up over the previous swing high. And we want to see it break out to new highs. And there was a question earlier today. And now, by the way, this chart, we're back to the 1931 market here. There was a question earlier about taking breakout trades. And Wyckoff would, in fact. It was his least favorite, but he would take a breakout trade. His most, I don't know if it was his most favorite. I shouldn't say it that way. But he would, if he were trading intraday and saw the climactic action and the heavy buying coming in on the selling climax here, as that's occurring, he would have a list of stocks kind of on the side, saying, okay, when the market turns, I want to be looking at these stocks to be buying. And he would begin to buy in at that point as the climax was occurring if he was trading intraday. He would make his second position somewhere around what he called the secondary test, or the testing of that climactic action. Okay. Notice, too, I didn't mention this earlier, but notice that the testing is coming back into the area of high volume. Okay. It's coming back into that same price area, kind of looking to see if it can't flush out any further sellers. Okay. And here, of course, it can't. So that would be where he would take his second position. And then, so long as the rally was good, he'd be looking to take his third position, or his next position, as it's breaking up above the last swing high. And that was confirmation then that the market, in fact, had turned, and we were now rallying up. We would now trade to the long side until conditions told by the market told us otherwise. Okay? Is that fairly clear to everybody? And what do we want to see on the rally, by the way? What is it that we're looking for? Just yep.
Where did he get his list from? The relative strength on the downside?
The question is, where did he get the list of stocks that he would select from? And yeah, he'd be tracking those stocks. He would know what the leaders were, and he would know what stocks had been in accumulation and were likely candidates for a good long trade, and he'd have those, as a list.
Gary, just so you know, they're built into the trade by the scanner right now. The exact same scanner.
And Gavin's making the point that there's a scanner in Trade Guider that will do that as well. Yeah. So what is it that we're looking for now on this rally? What do we want to see? Testing of the breakout, but even before we get there, how do we know that this is a bona fide rally as opposed to something different? Go ahead. Yeah, we want to see volume come into the upside, right? We want to see buying expand. We also want to see the spreads or the ranges of the bars expand as well, because that means activity, and that means that there's buying coming in and driving prices higher. Buyers are willing to come in and bid up and reach for those prices, okay, as it's going up. Very different than what we saw over here, isn't it? Where no one wanted to buy, everybody wanted to unload, and now we're seeing buying coming in, and it breaks to new highs. Okay? Is that pretty clear for everybody? Anybody got any questions on that? But as we're rallying up, it doesn't take long, as we all know, before, as Wyckoff tended to think in terms of waves, that the market Elliott, I think, would call it an impulse wave, and then there would be followed by some sort of a corrective wave, right? Wyckoff would say that there was, good, strong buying coming in, but we would also see a reactive wave coming in, okay? Momentum, another way to think about this is that momentum is coming into the upside, and then that's going to wane a little bit, and we're going to see some sort of a corrective reaction.
This is gone away from your mouth a bit there, so
Okay.
try that myself.
Thank you, Gavin. That felt good.
You get us in trouble.
I know. I'm already getting us in trouble. So what do we look for? What do we start to see then? How do we know that a corrective reaction is likely to take place here? We're starting to, I outlined it here, but what are some of the elements that we're looking for? The rally is starting to lose momentum by we're seeing volume begin to decrease, right? Exactly. Volume is starting to decrease. What else are we seeing? Closing now, instead of closing on the highs, we're starting to see closes more on the lows and in the middle of the range. The buyers aren't able to hold it all the way to the top the way they were here, right? I'll erase this just so you can see it more clearly. Here the buyers were really aggressive coming up. They were bidding this thing up all the way, right? Now, less so, right? As evidenced by the closes coming down on the lows and in the middle of the range. What else are we seeing besides the diminishing volume and the relatively poor closes? Something that Wyckoff talked about, and I suspect David will talk a lot about it as well, called shortening of the thrust. The thrusts here are the pushes up on each of these bars. And you can see that on each drive up, it's getting less and less. Okay, it's what we call shortening of the thrust, shortening of the up thrust. We see it on the downside as well, but here we're seeing it come in on the upside. So we're seeing diminishing volume. We're seeing inability to hold the highs on a closing basis. And we're seeing shortening of the thrust, that the more we try to drive up, the less progress we're making. And if you look here on the last 1, 2, 3, 4, 5 bars here, what do we notice about the closes in here on these 5 bars? They're all clustered around the same level, right? Maybe a point or two different, but basically they're all about the same level. So out of 5 days of trading, almost in this era, almost a week's worth of trading, no net material progress to the upside. So for all of those reasons, we can now begin to anticipate a corrective reaction. And so what do we want to see on a correction? If we want to, if assuming that the bullish move here is still intact, what kinds of things do we want to see? Yep. As we come down, we want to see volume remain fairly light. We'd like to see the spreads or the ranges of those bars not begin to expand like they did over here. If that starts to happen, then we know we might have some difficulty. We want to see them remain relatively tight. In other words, there's not a lot of interest to the downside, i.e. there's not a lot of selling going on, not a lot of supply going on. Okay? So let's take a look at a couple of markets here. Here's I have to look closely. ConocoPhillips, a great stock, often complies nicely with Wyckoff principles. You see the expansion in volume as we rally up, right? But notice, volume diminishes as we get up higher. And see how we are getting clustering of closes here, not making much progress to the upside over a few days here. And do you also see the shortening of the thrust, right? And then we come down and we have a bit of a corrective reaction, okay? This stuff hasn't changed, and you know why it hasn't changed? I'm also a psychologist, and people's behavior doesn't change in 100 years. It won't change in I'll venture 100,000 years, our behavior is basically going to be about the same 100,000 years from now as it is today. Maybe 50,000. I mean, we'll have some changes for sure, but we all basically, our mental machinery, our emotional machinery, and our behavioral repertoire doesn't change all that rapidly. It's evolutionarily based. It's heredity that we're talking about. And, you know, we know from Darwinian evolutionary theory and all of the psychobiological research that's going on, psychobiological meaning the research on the genetic components of our psychology, our mental and our emotional construction. It just doesn't change that rapidly. And when we're talking about groups, like a market, like a massive group, we're talking about the market as a large group, it changes even more slowly. Okay? So this stuff doesn't change and won't change in our lifetimes and in our grandchildren's lifetime. That's why it's so valuable to know. Here we see another corrective reaction. We pop up through a little bit of resistance. This is an S&P E-mini chart on a 5-minute basis. And you can see the shortening of the thrust. You can see the closes are a little bit poor. Now, highlighted here in the green box, the drive up, right, in terms of the volume, that's all bullish volume coming in as the market's moving higher. As it corrects and reacts, I drew a red box around that volume, kind of give you a sense of the waves, the volume on the waves. And you can see that it diminishes on the corrective reaction. So we're still bullish. There's nothing, no supply is coming in here. It's a pretty logical way to look at the market. Another corrective reaction on a stock here, an American stock, on a daily chart. You again can see the poor closes, the shortening of the thrust on each of the reactions. And once again, I highlighted where the volume is coming into the upside on the up move, right? And where it diminishes. And notice the spreads. Look carefully at this reaction. Look at the ranges or the spreads in this reaction and compare them to the ranges and the spreads here on the up move. The up move is much, David will talk about this in terms of ease of movement. It was easy to move the market up. Trade is facilitated to the upside. Not very easy to move it to the downside here, right?
Gary, sorry, we've got a question in here.
Sure.
Gary says, Dr. Gary, what is it to be done during corrective reaction? Hold or sell and re-enter on a further test? If you could just repeat that to the audience.
Yeah, the question is, what do you do on a corrective reaction? Do you just hold on, or do you sell out and then try to buy in at a lower price?
That's from Chris Naranian.
And that's from Chris. You know, it's kind of your own style of trading. If you are trading for the longer haul, you'd want to hold on through that correction if you're not seeing any negativity enter the market. And in this stock, we're not seeing that. And in fact, you could probably you could pyramid on if you wanted to, and take a additional position on the reaction, so long as it's corrective. And again, here I've highlighted the up and down volumes here to give you a sense. And the idea here is to help you to begin to think a little bit more structurally, if you will, about the market, not just about the individual bars on the right edge of the chart. It's easy to get seduced into what's happening on that right edge of the chart and ignore everything else. So what I'm trying to do is to help you see, as Wyckoff did, try to help you see the overall structure or complex of the market. Okay? It's just a slightly different look. And again, what we want to see on a bullish advance is volume increasing to the upside. And here you see that pretty nicely, illustrated even better. As we go higher, volume is coming in. We're back now, again, to the 1931 market. See how the chart's exactly the same? It's amazing, isn't it? When I first got I'll never forget this, when I first got the SMI course and it had charts from 1970s, right? I thought, 70s, how ancient, how relevant can this be? Little did I know.
Hey Gary, how do you explain then that the same principle works on a 1 minute chart as well as it does on a 1 week chart?
Yeah, it does. That's right. It's fractal. It's fractal. And it does. I'm showing you here weekly charts. Here's a 5-minute chart, daily charts, all different time frames. I don't go down below a 5-minute chart. Very rarely will I go below a 5-minute chart because it's just too much noise. But on this chart, I just highlighted in green the volume on the expanding spreads or ranges. And so you can see that the high volume is coming into the upside on the upwards, coming into the upside on the upwards, coming up. Okay, on a good solid spreads coming up. So it works on a 5-minute chart. So it works, it's the same on a 5-minute chart as it is on a weekly. And here, one more, just different. This is another kind of chart. This another bullish advance. This is on a daily chart with, and here I just highlighted it with a highlight marker. You can see the volume expands to the upside. Okay, so the message here is not just to see that volume comes into the upside and that's bullish, but also to help you to train your mind a little bit, your eyes from riveting right on the right edge, the last couple of bars on the chart, and to start to take in the whole panoply of the market, the whole field of the market. Okay. And another example, you can look at chart after chart after chart. This is what a bullish advance looks like. Okay, volume is coming in as we rally up. All the corrective waves are showing lighter volume. Now, a correction in a declining correction is one kind of correction. Wyckoff also identified another really interesting and really worthwhile thing to know, a different kind of corrective reaction, which is absorption. And maybe it's not fair to call it a corrective reaction. Maybe that's a misnaming of it. Because absorption really is all about absorbing the residual supply, whatever existing supply remains in the market at that level. What do we see here in this absorption area? Here we are back in the 1931 market. This was the rally up, and now the bullish advance. And now we're in this area here. Sorry, I'm kind of doing this one-handed. So I'm getting some childish-looking marks on the chart. But what is this? What do you notice about this absorption here? Pardon me? The highs are capped. Okay, there's a limitation to the high, right? It's trading in a range, and we're not seeing much movement up above that higher level, right? What else do you notice? Are we seeing much of a reaction here? I'll erase this here. Are we seeing a big reaction coming down? No, really. We're holding gains, right? We're holding our gains. It's one of the key characteristics of absorption. We're holding gains and basically going sideways. It's kind of like the market's resting almost, okay? Folks got excited over here and started to buy, thinking that the market was about to go to the moon, right? And then they'll sit through a reaction like this. And as it comes back up, and I think in this market too, Wyckoff talked about other supply that existed to the left-hand side that we don't see on the chart because it's not given to us, but more supply there. And maybe buyers tried to buy in as well, and they sat through Those poor fellows sat through the climaxes, and now as the market's coming back up, they're kind of happy because they can now get out at break even, right? And so that's what's creating some of the supply. Buyers who bought prematurely now coming back up, and they're unloading to get out. They've been suffering, through all the reaction, and now they're happy to get out at break even. So this is what we see in absorption, and typically in absorption, you'll see it not necessarily hang below the high like this. You'll see it also come up above, and I'll show you one or two unusual examples of absorption too. But as we dip down, each time we dip down, we're not drawing out significant supply. We're not drawing out high volume. We're seeing closes kind of towards the middle and high here. And right at the end, Wyckoff talked about this. We don't always see this. He talked about the volume beginning to increase right at the end, and also that the supports, the lows of the price bars, start to lift up, meaning that people are now getting more eager to buy at that level, and they're more willing to come in. This is not an easy thing to trade, absorption, by the way, but it's useful to know and useful to see. Here is a market. This is MWV, I think, on a daily, a medical stock, I think. You can see the supply area over here highlighted in yellow, and we're holding for a large number of days. By the way, in the 1931 chart, I think it was 15 or 19 days that it held at that level and just went sideways. And you can see here on a daily chart, maybe not 19 days, but quite a number of days just holding to the side. Volume starts to pick up as we come to the end, and the supports are lifting. And each time they dip it down, they do not draw out supply. A nice example of absorption. Couple of examples here on another daily chart. This is Ben Franklin, a U.S. stock, and they can occur at different levels. I've got the absorption levels here outlined in red, and the supply that they're negotiating over to the left, highlighted in yellow. So a different kind of a reaction. Here we are on a 5-minute chart, where we saw supply earlier in the morning in the S&Ps, and now things, of course, happen much more quickly on a 5-minute chart. So we're not going to necessarily see 19 or 20 bars of sideways movement, but here we're just not giving up any ground. We're holding the gains after we made a morning low here. Okay?
Might notice the 3 inside bars.
And 3 inside bars, yeah, that's right. Clusters inside bars are pretty significant too, indicating in this instance, I would say, David, that there's just no activity to the downside, no interest in moving this market down. Those inside bars. Inside the trading range, yeah. You pay a lot of attention to the inside bars, don't you? David Weiss is making the comment that there are several inside bars here. And a higher trading range. Gary Follett's making the point that we're down lower in a trading range, and now in this absorption area, we're holding, I would call it holding gains, but a different way to think about it is that there's a trading range that's occurring. Now on a 5-minute chart, we're here 1, 2, 3, 4, 5, 6, 7 bars, so that's a good half hour. And it's a small trading range at a higher level. It's a nice observation. Just another way to think about it. And that also, by the way, is helpful. Just from a mental side of things, the more different ways you can think about the same thing, the more different ways you can label it or see it, the stronger impression it will make on your mind, and the better able you will be in recognizing it when it comes into play at the live end of a chart. And there was a question here. Yeah, I was going to say breakout trades are not. The question here, the question is when you see an absorption period like this, are you prone? Are Are you kind of induced to enter during the absorption, or would you look for an entry on a breakout? And often we will see a breakout pretty aggressively from an absorption period. At least that's been my experience. Almost like a spring in a lot of ways. It will often take off. So it's not a bad, in my perspective, it's not a bad breakout trade to take. And if you can identify, if it's been going on for a while, depending on your time frame, if it's been going on for a couple of weeks, if you're trading on the daily, or if you're on a 5-minute chart and it's been going on for 45 minutes or so, and you start to see volume begin to pick up and those supports lift, those lows lift, I like that as a fairly aggressive but still not so bad trade to take. Gary, you got a comment? Yeah.
Also, the spring, if you notice the particular chart, it's the most, I'm sure from a trade guy, you haven't had it, because I've watched this. You have a fantastic, I don't mean to interrupt, but
No, go ahead.
you have a fantastic spring here, which would give, if you're in an uptrend market, that spring has to be bought. Now, I don't know much. I've watched VSA. Okay. I've watched VSA probably about 10 times. I snuck it in Gavin's room the last 2 months. But if it's an uptrend, as Dr. Gary was saying, that spring must be bought in that market. And you know what your risk is? 0. Because when you buy that spring, it's a successful spring. You want to buy springs and uptrends, and that is probably the most perfect entry you have. Even if the market fails, you won't lose money because you'll be able to stop immediately. I'm sure with VSA, they would probably had their dime or whatever their parameters are, would have caught that move.
We just call them VSA indicators, but yeah, exactly that. They just give a visual cue on the screen. So basically, what happens when an indicator appears? Gary's using the Trade Guide charts here, and it's a naked chart. So so bar by bar, as we look at bar by bar, yep. Experienced people can say, right, you can go and watch this seminar. But if you've got the software, what it does, well, if you've seen some of the last trading rooms that I've been doing, before the bar fills, you anticipate exactly what the indicator is. It's just a method to speed up the chart reading that you do. But then we have proprietary trending systems which align. And I have just a very simple rule. Rob and I, when we trade together, it's very similar. We're trading the trend. We're looking for thrusts. We're looking for pullbacks. I love to trade a test in a rising market, which is a very high probability trade if you see it. At the other end of the scale, at a short, is, as I've said earlier, you look for the Yao Ming up bar, which is deliberately designed to catch all the uninformed herd as they buy up that bar. And if it's genuine no demand, that means, or genuine weakness, it'll be confirmed because the market will dip and go back up to the same area, much, much lower volume. And you'll see this very, very clearly on your charts if you're using the channels. And if you get one of those setups in the right place on the channel, that's where your entry is going to come. But it's interesting that what you're showing here has just been, all Tom has done is computerized the indicators to show the principles. But the clever bit that Tom did, and we're going to talk, by the way, tomorrow morning, we're going to start a little earlier, about 8:30. Tom has got some very exciting stuff to show you. He's got his newsletter. We're going to give you all a copy of the newsletter. Everyone that's online, everyone that's here, we'll get the newsletter for you. So you'll see his newsletter, what he says the market's going to do next week. He's not been wrong yet, has he? So it will be very interesting to see what he's got to say. So back over to Gary. About another 15? Yep.
Great. That was a great observation. Yeah, absolutely. Springs, I know that David will talk. I shouldn't say no, because I don't know exactly what he's going to talk about. But, yeah, he will. Yeah, if he doesn't talk about springs, I'd be really surprised. A spring, for those of you who may not know, and I'm sorry I'm drawing this should be a straight line here. A spring, especially in an uptrend, is a really wonderful trade. As Gary Follett says, you must take that trade, and I agree with him. It's one of my favorite trades, and I know it's one of David's favorite trades. A spring is price coming down, dipping below a support level, as it does here. Our support level is, I'll just put it in here as A, sort of on my childish writing here. We dip down below that support, pop back up above it, and close firmly above that support level. The market then has a good, especially in an uptrend, has a very high odds of taking off to the upside. And that's what it does here. And this is the S&Ps, I don't know, last week, the week before, I forget exactly what day this was, but we've been in an uptrend since March of 2009. So, yep. On the spring, yeah, I'll let David talk about that. He'll give you all kinds of details about springs, and Gary too. Here's another. I'm sorry.
Just a question. George came in and said, "Well, isn't that sideways movement the spring just the action of the close on the London market?" And I wouldn't say that's just that. I mean, if they're going to spring the market, they're going to have a plan to do that well in advance.
Yeah, I would think so. They're coming in and testing. I'm assuming that this is the overnight lows here. They're testing this on the spring. Here's another example of absorption. Notice in this one, I put this one in because this is a little more choppy. We don't always get nice, neat, clean little inside bars and top, nicely shaved top here. Sometimes it gets more sloppy, if you will. But still, nevertheless, it's holding its gains. That's the key thing here, okay? And you can see, I marked it here at 2, the volume starts to increase as we start to rally out of this. And it's just a key thing to look for in absorption. Here's an unusual example of absorption. I don't know if this would quite fit Wyckoff or not, but it's something that I saw and view it as absorption. Here we're in the S&P E-minis, and we gap open, and it was a big gap. I think this was 16 or 17-point gap, maybe even a little bit more than that. And we gap underneath the low from 2 days back, and that's highlighted in this purple heavy line here. And we dip down, some buying came in, we rally up, but pretty weak and lackluster rally up to the 2-day low. And we come back down, and similar to the rally, pretty weak and lackluster. We're not really seeing much supply come into the downside. We put in a higher low, and then we rally back up, and we hold here. And we hold our gains just underneath that 2-day low. And then we push up through. And again, you can see the increase in volume at the end and the supports lifting here. And to me, this was absorption of that supply that came in. For those of you who trade the S&P E-minis intraday, if you use ticks, you'll often see the ticks hold and hold nicely here. If you don't use the ticks, that's okay. We're not really talking about ticks today, but it's just a little side thing. I like to use them in trading the S&Ps. But that's an unusual example. And then, as we started off with a selling climax, all good bullish trends must come to an end. And we will often, though not always, but especially on the intraday and on individual stocks, we will see some climactic action. So what are some of the characteristics of a buying climax? Let me throw that out to you. What do you think? I'm sorry? Mm-hmm. Yep. It's going to be the flip side of the selling climax for the most part, right? We're going to see wider spread bars. We're going to see heavier volume. We're going to see the acceleration of the trend to the upside, okay? And just like in the selling climax, though now on the reverse, people who've been on the sidelines watching the market go up and up and up all tend to act at the same time. They might have been sitting on the sidelines saying, gee, I really want to get a hold of that Microsoft stock or whatever stock is the hot stock for the day. And they just can't stand it anymore. And they all tend to act in unison. And that's a point when those who were smart and bought down below, they have an opportunity to unload while the market's nice and active. Okay, that's the basic Wyckoff idea behind a buying climax. And this, again, is the 1931 market. You can see at bar 1, we don't have really super wide spreads here, but we certainly have the acceleration in the stride. You can see that we've been going up. Actually, we've been going up from here, and then the blue line and then the red line gets steeper and steeper. We see the highest volume on the chart come in at 1. The close is fairly poor. The next bar, bar number 2, what I would call sustained volume, still pretty high volume, and it's closing down low. And the bar after that, bar 3, tries to rally up, and on an increase in volume, closes poorly. Wyckoff, and we'll talk about this tomorrow more so, Wyckoff said that this was really a change of behavior. Prior to this, in the uptrend, when we've reacted, the reaction has been on relatively narrow spreads, and the volume dries up pretty quickly as we come down. And here we're seeing not only the highest volume on the chart, but we're also seeing volume come into the downside for the first time. And that's a mark of supply coming in spades into the market. Everybody understand that? Everybody see that? And so here's just some examples of buying climaxes. You can see the acceleration in the stride. You can see at bar number 1 there, the high volume, highest on the chart, poor close. Next bar is down. And then we get a bar that wipes out quite a few days or bars of selling days here. This is this is Western Digital stock. Quite a few days of selling, and that's just supply coming into the market. Okay. Another example, we don't really get, oh yeah, we do. We get a nice acceleration in the stride. We get high volume coming in, poor closes, and then the market starts to come off. Another buying climax. Here we don't really get the strong volume coming in, but I wanted just to flag this. Here we see on a 15-minute chart volume being sustained to the downside, as highlighted in yellow. Then as it tries to rally up, there's no volume that comes in. There's no buying coming in. This, by the way, I think was the 16th. Yeah, this was the day that Goldman Sachs was identified for fraud by the SEC. So we've covered quite a bit, actually, in a fairly short period of time. We've talked about buying climaxes and selling climaxes. We've talked about how we've talked about secondary tests and about bullish advances and how things come together and lead us to a corrective reaction that we can actually see in the market before it occurs. We've talked about absorption, and we've talked about climactic action in terms of comparative strength and weakness. And you can do the same thing, by the way, on a buying climax as you can on a selling climax. If you're not sure, looking at other stocks or other sectors, you'll see some of those leading stocks and leading sectors be weaker than the market, and gives you, just as we saw, being stronger than the market. So from the 1930-31 case study that Wyckoff did of the New York Times index, we've pulled out the major principles that he talked about on the bullish side. And we've compared or shown how they work in the current markets as well. And it's pretty convincing stuff. I mean, you can see it from 1931, and you can see it from this past week on the 5-minute S&P chart. So with that, I'll wrap up. Any questions about anything we've covered? All right. Well, I want to thank you very much, and I'll turn it back to Gavin.
Perfect.